Well, let's face it, we came so close to another depression that people called the last few years the Great Recession. But my next guest calls it something else completely. He calls it the Great Shakeout. He says the Dow rising is not necessarily a good thing in a bad economy, but you could still take advantage of it. With me to explain is Keith Springer, the president of Capital Financial Services. Keith, welcome. Great to see you.
Oh, you too, Jerry. Thank you.
So what do you mean by the Great Shakeout, and how do I take advantage of this bizarre market in which stocks are running out way ahead of what's really going on in the economy?
Well, what we've got is a double or almost a triple whammy. We've got an aging population, the demographic situation, where you have an aging population spending less and saving more. You've got people without jobs, as you were just talking about, and there's a lot of people without jobs, so they don't have the money. And then you've got people with balance sheet repair items, issues. They've got to start paying off their debt. So what that means is less aggregate demand in the economy.
Right.
And less aggregate demand just means less supply needed, less goods and services need to be made. So unfortunately, there's not going to be a lot more jobs. And what it leads to is slower demand leads to slower supply.
Right. Well,
I
think we're all aware of that. The economy continues to suffer. GDP, that's the broadest measure of economic growth. Wow, it's below 3%. It should be at 5 or 6 at this point in a recovery, and it's not. The big worry is that the economy is going to go back into the tank again. So if I'm trying to make money in stocks, what do I buy?
You want to go where the sweet spot is. You can't look at all or none. Too many people look at the market and think it's going to go up, going to go down, it's going to run up or down, and they bet all or none. Look for the sweet spot. Right now, there's tremendous opportunities on income and dividends. You can find 8, 9, 10% yields on MLPs, preferreds, corporate bonds, and that's exactly what we did for our clients and put together our hedge dividend portfolio.
MLPs being what? Master limited partnerships? What are you talking about?
Exactly. Master limited partnerships that have very good yields. They have appreciation potential. They also give some tax advantages and taxable accounts. So there's really great opportunities in these types of things.
But you're not talking about, say, going out and buying an index. You're not saying go out and buy the S&P 500 necessarily.
Absolutely not. To me, Jerry, that's more of a gamble. You're betting up or down. And, you can go to the craps table and be right some of the time, but it's too dangerous right here. If you invest in the sweet spot, our hedge dividend portfolio is designed for the moderate risk investor. You can pick up these yields, use inverse funds to protect the downside.
Ooh, inverse, so that sounds like hedging. Are you having me hedge?
Well, if in a managed portfolio you would hedge, but in a very simple way. You simply buy inverse funds to protect the downside. So, Jerry, if you could get a market-neutral approach.
Please.
An inverse fund is a fund that goes up when the market goes down. So all you use it for is not as a gamble, simply to protect your principal so you can collect the dividends. If you can pick up dividends averaging 8, 9, 10%, you collect these dividends, but you protect your downside with those funds. So it's a very simple approach, and you sort of are investing in a niche, a very sweet spot of the economy.
That's the interesting little secret, I think, about people who have been investing in stocks all along, even though the markets have gone down. If you were invested in companies that paid nice, hefty dividends, you did get that return over time. And it's not like you actually lost money, even though the levels of the indexes over, say, 10 years just simply didn't do that well.
No, you hit it right on the button, because dividends account for over 50% of the stock market's return since 1926 and over 100% over the last 10 years. And the uncertainty in the economy is creating tremendous opportunities in this little niche marketplace. Everybody looks at the market and thinks of it as all or none. Oh, I've got to buy stocks. I've got to buy the best stock. I've got to trade the best stock.
Well, I want to get you to something else. Niche. We don't have a lot of time, but I know there's a lot of concern among a lot of people out there about their bonds. A lot of people invested in treasuries. Do you feel like that's a market that's ready to just explode? Is it a bubble waiting to burst?
No, because a bubble is a speculative action, and there's no speculative action. There's a reason that interest rates keep going lower, and there's less aggregate demand, which we discussed. There's going to be absolutely no inflation, and I believe there's going to be deflation, which means there's even more room for bonds to go. Wow. I don't see a tremendous risk.
Keith, that's not good news.
There's not a whole lot of risk in bonds.
That's not good news about the economy if you think we're hitting deflation.
No, it's really not. In fact, in the economy, but that's the idea of investing regardless of what the economy does, regardless of what the market does, finding that little niche. And bondholders, if you're buying it for speculation, that's different. If you're buying it for the income or for the protection on a portfolio, that's perfect. But you can't be affected too much by swings in it, right? Because if the economy goes one way or the other, you don't want to risk too much of your money in any way. That's called speculation.
All right.
That's why I sort of push and find that little niche.
All right. We'll be looking for our niche. I appreciate that. Keith, thanks for the help
All
today.
right, Joe, thank you.